Let's get the big picture with Jeremy Zirin. He's Chief Equity Strategist at UBS Financial Services. Jeremy helps oversee $774 billion in assets. That's a lot of money to play with. That's a lot of losses this week. Talk to me about your clients, Jeremy. I mean, were they calling, phones ringing off the hook, worried about what to do in this market environment?
Sure. At the beginning of the week, we actually moved to a moderate underweight in global equities and took some risk off the table. I certainly didn't foresee the 6.5% decline in 5 trading days likely to transpire. But broadly, we have a dichotomy in the market right now where we have very cheap valuations, but those valuations probably aren't going to mean a whole lot until one of two things really happen. One, we need to see better macros, and two, we need to see a better plan coming out of European policymakers.
Well, that's a good point. I mean, so until we get that, I mean, if we start to get all that, we start to see something out of the policymakers out of Europe. I mean, could sentiment change very quickly in your view?
Sentiment could change, but right now what we're seeing in terms of even the U.S. economic data, we have such weak sentiment numbers and still fairly moderate hard data in terms of retail sales, in terms of industrial production. And our bias is to believe that, the longer that the weak sentiment remains in place, that the hard data is more likely to start to weaken. And so our bias is that, it's possible we could get an improvement in sentiment, but we don't really see any policy plan in place that's likely to do that. And I think our bias, at least in the near term, is to the downside.
Yeah, I was going to ask what could boost sentiment beyond a boost in jobs here. I mean, beyond a boost in growth. As long as you're skating dangerously close to a recession, and as long as you have unemployment, the headline figures at 9%, the real figures at 20 or 25, you're not going to get confidence back, are you?
Well, I think the Federal Reserve didn't do the market any favors this week by issuing a statement that said that there's significant downside economic risks in terms of what the investor sentiment was, and it wasn't terribly surprising after that statement and no press conference after the 2-day meeting that we saw markets drop almost 5% in 2 days. So in order to restore confidence, we need more clarity out of policymakers, both here domestically in terms of the super committee, in terms of what our long-term debt dynamics will be. But ultimately, I think the key issue for markets has been for the past several weeks and will continue to be for the next several weeks, what is happening in terms of European policymakers trying to contain their ongoing their sovereign debt crisis.
It's interesting because we've been talking to a lot of folks about what's going on in Europe. We did catch up with Terry Keeley over at BlackRock. He's a managing director, and he said that basically what everybody's looking for is concrete proposals from policymakers, and at this point they're not seeing them. Listen up, everyone.
In our bilateral meetings, I can't tell you how clear it is with finance ministers, central bank governors, that there's something that must be done, something must come out of this weekend. I think markets need to take a breather. I think there's a lot more yet to come from the policy side that will calm markets.
I mean, Jeremy, he sounds certainly optimistic, Terry Keeley from BlackRock, that we're going to get something that's going to calm the markets. I mean, European officials have to be watching, U.S. officials have got to be watching what's going on in the markets, the turmoil, and they've got to, realize something has to be done at this point. We can't wait anymore. I mean, the Greek crisis has gone on for 2 years. Do you feel like it's starting to register finally among officials?
I'll believe it when I see it. I mean, we haven't seen any evidence that their policymakers in Europe are taking any type of, concrete or proactive approach to solving their debt crisis. So given the fact that it has, Parliament, there's 17 parliaments involved, and this is by construction a slow-moving process, I think to think that we're going to get concrete proposals and really have any type of ring fence in terms of the magnitude of the amounts that would need to be communicated to the markets of an expansion of the EFSF or concrete proposals for the ESM. It seems to be fairly far-fetched to believe that's going to happen over a weekend meeting.
So what do you do then? Where do you put your money at this point?
Yeah, the way we're positioned within global equities is we like the more defensive U.S. market. U.S. companies have managed through this cycle very well. They've held profit margins at fairly robust levels. We think U.S. will be more defensive than Europe or even emerging economies. And even within the U.S., I would recommend look for those companies that either have a relatively strong dividend growth component, so consumer staples sector, defensive sector with strong, relatively high dividends in a low-yielding world, where you're also getting not just higher yields, but also getting growth in your dividend. And within the cyclical areas of the market, stick with the defensive cyclicals like technology. Technology earnings trends have been fantastic, whereas I think that there's a lot of earnings risk for other cyclical areas of the market like industrials, materials, and energy, where we've seen commodity prices really roll over lately.
Hey, I wanted to ask about that because obviously we've seen commodities get spanked today, especially gold right now down $100 at 1645. People had been talking for a while about the gold producers that hadn't moved up to the gain in price in the underlying commodity. Does this make more sense?
I mean, I would look at the action in the copper markets and in the oil markets and see the copper's down, almost 30% off its peak, and it's really a pretty good indication that global growth is slowing, and that's why materials and industrials have been lagging, not necessarily because of the space and the action in the press metals.
Jeremy, isn't copper purely a China play, and it doesn't look like growth there really has slowed that much? I mean, if you think it's going to, like Jim Chanos, it makes sense. Gary Schilling also has been shorting copper on that theory, but 9.5% growth is still nothing to shake a stick at.
Well, the last 3 months what we've seen is that the Purchasing Managers Index in China has been below 50%, or below the 50 mark. So China is growing 9.5% right now. Over the next year or two, we're more likely to see something in the range of 7 or 8%. Certainly not a, China's not going to be falling off a cliff, but it's going to be slowing.
Guys, I want to jump in because actually one of our regular guests called me Carol Rubini Rogers Faber because I was so negative yesterday. But I actually found some optimism in some of our stories and some economic data, and this has to do with rail shipments. And I want to just point it out to everybody because we're so concerned about a double-dip recession. It's really worrying investors, but there is a bit of good news. Check this out. Railroad shipments are on track to post their highest numbers in almost 3 years. Total rail volumes, excluding coal and grain, averaged almost 382,000 carloads in August. That is the most since October of 2008. So, Jeremy, when you hear something like that, can you count on that? Does that mean, no, we're not going to see a double dip, we're not going to go into recession? Because you have become gradually more cautious here.
We've been more cautious. I mean, over a medium or even a long-term perspective, I'd be more constructive on equities. I think the near-term event risks out of Europe, as well as the fact that we haven't seen a better macro environment in terms of decelerating leading economic indicators, keeps me cautious and leads me to believe that the probability of recession is rising, and investors aren't going to be convinced that we're not going into a double dip, probably for at least a couple of months. Now, our base case remains that we're going to avoid recession here in the U.S., but we're seeing leading economic indicators outside of the U.S. start to roll over, and that gets us mostly quite concerned about equity markets.
Hey, we want to roll in a trader's perspective right here. Let's shout it out to Kevin Cook, senior stock strategist at Zacks.com. He is at the CME Group out in Chicago. He trades equities, currencies, and commodities. Kevin, I'm guessing you had a pretty busy week here and probably are glad it's over. What are you expecting next week?
I think we're going to see more of the same selling. Today has just been a pause day, and I listen to portfolio managers. You just had one on. The gentleman said that, hey, there's a lot of great equity valuations here, but they're concerned about the macro environment, they're concerned about Europe, and you're staying away from cyclicals, energy, industrials, materials. So this market, we've cracked 1135, 1140. We've traded up there today. We're going to probably trade back up there next week. But we're destined to crack through 1100, and 1050 is the next target on the S&P.
All right, so the only thing, once again, you can count on is volatility. Hey, Kevin, thank you so much. Have a good weekend. And also our thanks to Jeremy Zirin, UBS Financial Services out there at the UBS camera.